the Silicon Valley real estate market during COVID-19, okay? And as you see here, I basically, this is the last data that I compile is from 5/7, okay? So what is the market saying about the Silicon Valley? And every time I talk about the Silicon Valley real estate, I always start with what is the Silicon Valley economy. Because as I mentioned before, and I will repeat myself a few times probably this presentation, is that the Silicon Valley real estate market is a derivative of the local economy, okay, period. It's not because we have beautiful country, the landscape is beautiful, we have great weather, we have good schools, there's limited land and so on. That's all secondary. The primary factors impacting the real estate market is the local economy, period. So what does the market tell us about the local economy? And as I indicated before, for me, it's basically looking at those SV 150 and the local companies, how they perform in this markets. So obviously, this is the correction that happened back in end of February last year. We see a major correction that took place, and ever since we see a major recovery. And look carefully what it actually shows us. It shows us that the Silicon Valley companies, the 100, the largest companies, and particularly the 20th largest company, they already have recovered their losses, okay? They recovered the losses, while the S&P is still lagging. And the S&P is still lagging even though that it gets a lift from the technology component in the S&P 500. So basically what that tells me is that the market views those high-tech companies as the one that they're gonna be hurt. There's no question in my mind that those companies are gonna be hurt. But nevertheless, though, they will be part of the recovery and success of the future economy that we're gonna be participating post the COVID-19, whenever that's gonna happen. And when we look at the employment in Silicon Valley, let me just remove that stuff. Layoffs, okay? This is something which I basically this is from an interview with 95, there is something called here the Silicon Valley Leadership Council, and that's basically, it's a poll of Silicon Valley, 350, in this group of Silicon Valley CEO, there's about 350 people across multiple industries. And in the last survey that was published on 5/7 a few days ago, 95 of the 350 CEOs of Silicon Valley responded to this to the question about hiring. And as you can see here, we see here 32 people are 3.2% are basically talking about layoff. We see another percentage already doing layoff. So we basically see about 15% of Silicon Valley CEOs are already engaged in layoff. A very dramatic change from the previous study when business as usual, 2 weeks ago, roughly 2 weeks ago to 3 weeks ago, 61% of Silicon Valley CEO that responded to the survey said that they expect to see business as usual. The new update dropped from 61 to almost 16%, a significant drop to the business as usual. And obviously, we also see here that hiring is only essential and hiring frozen is a significant of the market. So clearly, we see the first signs of Silicon Valley companies are starting to basically put the brakes on hiring. Okay, so if we move forward, this is an article that we saw back in also April 9, 800,000 Bay Area jobs may be lost. California faces nearly 4 million job losses, and that was back in April 19. As we look at that, what's the highlight of this article? Bay Area expected to lose a significant number of people, various areas, different jobs. Santa Clara, 204 jobs, San Francisco, and so on and so forth, different areas, different impact. The great economic spend would be hit by middle to low income segment of the market, which are already been struggling for quite some time. And that is also a very important fact, is that Santa Clara will probably have the best economic performance in the states. Tech-oriented economy is more resistant to other industry. Also, very important thing when we are kind of bringing it back to real estate. Bay Area economy, job market are headed for a significant rebound. And we're going to see whether that's going to happen or not. I'm a little bit more skeptical about it. And also the article that was published by the CEO survey is also a little bit skeptic about that. And we're going to see prior crisis that it took a little bit longer for Silicon Valley than a summer to recover from the jobs. But nevertheless, that's what the article says. Also, this is actually an article from Friday that actually it's kind of almost a month later. And they already, while we already have 4 million jobs lost in California, we see that that pace of job loss is slowing down. So that's kind of a good news. Okay, 4 million lost their job, but the pace of losses is slowing down. One of those articles a month ago, Tesla plans furloughs and pay cuts. And the reason I'm actually highlighting the pay cuts is, and if you look at below there, exact salaries can drop by 30% and non-essential stop kills healthcare. So basically, if we go back to the affordability and back to how lenders are looking at how much money they are willing to lend you, the moment your income drops, obviously your buying power is dropping as well. So that is for exact. I don't know what's going to happen for the rest of there and different industry, but definitely from my conversation with other colleagues and clients who are in the high-tech business, we definitely hear clearly there are jobs cuts and forced vacation, talks about reducing their RSU allocation and all that kind of stuff. So we definitely see that those that has implication on Silicon Valley across the board. Obviously, we see here Yelp is laying off people as well as furloughs. We see here something which is not only the layoffs, pay cuts hitting more white-collar jobs, doctors, office, law firms, and so on. So we see that this pain is not only in the tier 3, tier 2 people, but also in the tier 1 employment. We see that across the board. It's not only limited to tier 2 and 3. GoPro is laying off people. Airbnb cut 25% of their workforce. Uber has 3,700 people and so on. And what we see here, published here last week, is in our particular area, we see 74,000 only in April timeframe. And if we look at the industry that were impacted, we see hotels, okay? We see hotels, we see distributors, we see Goodwill, we see restaurants, and we see here another hotel, and we see some high-tech companies, okay? That's high-tech companies here, but they're talking more about furloughs versus layoffs. So we do see that this is going across the board. It's not limited to tier 2 and tier 3 industries. And this is something, and the kind of companies that we will see in the high-tech sector, which are going to be impacted, these are tech companies that are involved in the what I call the consumer-based economy, whether it's the Yelp, Groupon, Toast, Expedia, Traviago, travel, restaurants, and so on. These are the companies that are going to be impacted, even though they are in high tech, but their consumers, their clients are serving the consumer, which is 2/3 of the economy. So obviously, when we see levels of 33+ million people unemployed, it obviously going to have impact on the entire economy as well on the Silicon Valley high-tech industry. The industry in Silicon Valley, which is most susceptible to be impacted by that, is the companies that are treating or catering to the consumer-based economy, unlike the back-end economy. We have seen numbers from Facebook, Google, Microsoft, Oracle, Salesforce, and so on that are actually have performed relatively well. So if we look at another published joint venture Silicon Valley, again, these are all resources that many of you can benefit and by tracking. And what we see impact on hiring, unemployment, and commercial space, and so on. So what are the highlights of those articles? Okay, since March, we see local startup laid off 17K employees, okay? A significant number. Funding is far more challenging than it has been in many years, and many could fail as a result, okay? So we see in the high-tech segment, in the startup industry, there will be quite casualties, and we already have seen a significant casualty. And by the way, in this CNBC published interview, there is a talk about 44,000 across the world startup business industry is shedding employees. What we also see, a very interesting one, established tech companies business is even busier than before, and people around the world lean heavily on social media. This is a very important factor and part of the reason I'm cautiously optimistic about Silicon Valley in general, is that we live today in a world which depends more and more about technology, and who better than Silicon Valley is basically suited to benefit from that kind of resurgence of dependence on it. Nevertheless, there is some interesting implication for this kind of new world, and obviously it depends how long it's going to last, is the fact that what we are seeing, that we are realizing that more and more people can work remotely. So obviously enabled by technologies which were developed locally, but what's the impact? What's the impact on Silicon Valley here when people don't necessarily have to live in Silicon Valley, okay? Obviously, we have impact on commercial real estate, on residential real estate. Do we really need all those offices? As I'm sure many of you are aware, Google is investing heavily, and Facebook in Google Village, Willow Village. Apple is investing a lot of real estate in Silicon Valley. How will that new world going to impact commercial real estate? How much of this world will basically impact the fact that people don't necessarily have to live here? Will we still have to be in Silicon Valley physically to be in Silicon Valley? Or will the world be a little bit different than what it is? We can also carry it forward and talk about the new world. Does the United States really need 3,000 plus universities? What about when we are moving into this new world of online learning? And let's say maybe we're going to have only 500 universities, the best in the country, and everyone will be able to get a degree from Stanford, the NYU, UCLA, and so on, just by learning online, and what that will impact the university cities, residential or student housing, and so on. These are all very interesting questions that at this time nobody has an answer to. So if we move forward, so we talk about potentially at-risk industries, okay? So we look at Silicon Valley. The at-risk industry comprises about 27% of the Silicon Valley workforce, and that is a significant number of people in our area. There is a less clarity implication of pandemic housing market on the long run, whether, as we discussed earlier, what's the implication of this new normal on Silicon Valley real estate, on the both residential as well as on the commercial real estate, okay? And obviously the big variable that is missing in this entire conversation is what really going to happen. You know, there is, as we talked before, will we experience convergence of flu season with the COVID-19 in the winter? What will be the implication of relaxing those social distance on the United States, on Silicon Valley? What's the implication? There are significant unknowns that we do not know at this stage, and we cannot speculate on how the future going to look like. Some interesting stat is that some Bay Area might escape employment crisis. And that's a very actually interesting point, because what we see here, and I want to share with you here, is that Silicon Valley, which is basically a high-tech knowledge-based industries, okay, what we see here that in those areas that we have indicated before, where there's a strong demand for housing, basically as a result of new employees moving in, we see that in those areas, so what is the percentage of high risk residents who live in each one of those cities? So for instance, in Los Gatos, Cupertino, one can say and wow, 20% of the population is at risk because of this economical crisis that is knocking on the door. We look at cities like Mountain View, Palo Alto, and Los Altos, 21% of that population is at high risk of losing their job and so on. And if we look, San Francisco is about 33%, and East San Jose is 50%. If we're going to map all those areas now to the tier 1, tier 2, and tier 3, you're clearly going to see that in East San Jose, the majority of the population is a tier 2 and tier 3 people. And if we look at Los Gatos, Mountain View, and so on, these are mostly a tier 1 employees. So that's very much kind of tells you what the potential impact on those particular cities. Okay, now with a caveat here, it obviously depends how long and how deep that pandemic, the crisis is going to continue. Obviously, the longer it will continue, the more significant impact it will have on our area. So what is happening in the real estate market during the COVID-19 period? So what we see here, that number one, it is basically between March and just recently, the entire real estate market was on hold, okay? So that we do not have really a good statistics about what is actually happened. Mostly we have a sort of, and obviously on March 28th, we see some real estate was added to the essential services. So we see some beginning of some transaction and engagement, but very limited. So what we have basically, we have mostly anecdotal data from our offices, from conversation, from looking at some data. We do not have a good data to tell you exactly what are the long-term trends yet. And particularly when real estate typically, even though when you go into a transaction, it typically these days goes between 25 and 35 plus days. So we always have some lag time on actually telling you accurately what is really the impact of this pandemic. In addition to that, there isn't a single real estate market, okay? There is micro market, there are multiple market segments, and they can be basically looked at three. I kind of look at them and for sake of simplicity, to some extent, look at three markets: the sub 1 million market, the market between 1 and 3 million, and the 3 plus. And each one of those markets is behaving differently. We're going to touch it a little bit later down the road. But what we also see here, when we look at our area in general, the area that we've kind of, in a sense, touched about being Silicon Valley. So what do we see? Clearly, we see implication. If we compare home listed in March 19 compared to the 220. So obviously, what we see here, that there is definitely a drop in terms of listing. Here, the gold, basically yellow gold, whatever is the color, we see almost 50% drop in terms of new listing between comparing to last year to this year. Some of that actually is the COVID-19, and some of them is the fact, long-time trend that we've seen inventory dropping. If we look at sold listing, obviously, and again, remember, there is always a lag time between the time a property is on the market and it sells. It takes between 25 to 40 days plus minus to actually sold. So some of that information is basically the sale that happened here actually occurred here 25 to 30 days before that. If we look at sold here, we see 30% drop here. We see new listing, 40% drop, change in continued. We see a drop all over the market. TFT is transaction fell out of escrow. Basically, people who actually, their offer was accepted, they got cold feet, and they decided basically to walk away. So we see here 14%. People who canceled their listing, we see 20%. And people who, sellers who withdrew their properties off the market, a significant 67% of growth compared to the previous year. So clearly we see an impact on this pandemic because this uncertainty that is taking place in the market. So if we now look coming from the kind of the Silicon Valley and looking more into our area, this is the San Mateo County, okay? Single family San Mateo country. And what we see, this is from 2018. Typically, it raises up. We look at here at, this is basically contingent pending, okay? This is basically properties are going into contract. So we see the typical seasonality of the market going up in the beginning of the first half of the year and kind of flattening in the summer and going down to the end of the year. We see 19 again, going up, flattening, and here we are at 2019. We see that starting the typical start, but immediately it basically being stopped and halted. Basically the market got frozen. And if we look at the relationship, obviously, between sales price and this price, so the typical price going up in the beginning, kind of, and this is the 2019 that we talked before about when the real estate, the interest rate went up, and basically the market basically stopped. See the following year starting, the year starting, the 19 starting, kind of was a little bit of increase, but it was a little bit flat, and we see a very strong start for 2020. That's what we talked before about the strong backwind of the stock market, interest rate, and low inventory that basically caused prices to fetch higher than asking price. And we see that the same from the Santa Clara County also. This was for Santa Clara County, the same typical behavior we saw before, okay? And here again, we see increase, but the market is slowing down here. And again, the prices, we see the 19 prices going up, the last quarter of 18 coming down. The market in 2019 kind of a little bit flat and going up. And again, a very strong start for 2020, which was stopped obviously because of the COVID-19. So that's more locally in Silicon Valley. So here's the summary of the during the COVID-19 summary, my take, okay? Silicon Valley economy is shedding jobs in all three tiers, okay? Three tiers. Many non-essential businesses are on the verge of disappearing for good, okay? Very important thing, okay? The entire transaction process is under a lot of stress and challenges. Preparing and viewing listing was almost extremely difficult. Recently, it's getting better because of the relaxation of the shelter in place. As real estate is the California Association of Real Estate with the county is relaxing some of those restrictions and make it a little bit easier than it was before. The lending market, which somebody asked me before, is very unstable and to some extent non-existent. And what we see here, that some jumbo loans basically are disappearing of the market. And one of the key issues there is lenders are very concerned about something called forbearance. Forbearance is basically the ability of buyers to ask the lender for at least the first 3 months to stop making the payment and adding those payments to the back end of the mortgage. So lenders are very concerned about the fact that the moment they're going to close the loan, the buyers immediately going to file for forbearance and they would not get any paid. The problem is even bigger because many of those lenders are using some service provider to basically serve their loan, and they have committed to making those payments. But those service providers are basically using bonds to be able to fund those loans. The moment that basically they don't have the bonds and people cannot issue new bonds, and the people are filing for forbearance, basically they freeze the market and they basically put them in a position of bankruptcy. So what we see here, that those kind of markets are starting to freeze, and on top of that, we see that a lot of lenders are constantly changing their lending requirements. For instance, Bank of America in some of our sections, depends on the loan and so on, have increased their down payment to a minimum of $3 million. Wells Fargo have reduced their maximum loan amount. So we see a lot of changes taking place in our industry, and a lot of very restricted about how much reserve you need, who gets the loan, and so on. So definitely the mortgage lending market has changed quite dramatically. We used to have something in Sereno and Compass and other companies that would allow you to borrow money to buy a new home before you sell your existing home, as well as would lend you money to some improvement so you can bring the house to the market. Both of those programs were eliminated for now, and those no longer provided because of this uncertainty that is taking place in the market. So we finished the second segment of our presentation. Please go ahead, and we have 5 minutes, actually 5 minutes to ask questions. Before, obviously, one more point that I failed to mention here. Obviously, until the COVID-19 is under control, full impact is unpredictable. Please go ahead and ask me questions. Questions? Please go.
We have a question here from Joseph. Is the S&P 150 and the S&P reflecting the real economy?
Oh, this is an excellent question. There is always this question of the Main Street versus Wall Street. There's an article actually, I think in the Wall Street Journal today about this question, Wall Street versus Main Street. So of course it does not reflect the real, the Main Street economy. And also what it does, because the S&P 500 is an index which is impacted now very dramatically from the high-tech companies. While we see in the S&P 500, we have hotels, we have airlines, we have oil companies, which are suffering significantly. But so what you need to do, you cannot look anymore on those indexes as a reflection of the entire economy, but you have to look at the individual player, individual segment to understand what's going on in the economy. Nevertheless, though, if we look at if we remember that actually the stock market is the anticipation for the future versus the current situation. Yes, there is suffering, there is pain in the local economy, but also the S&P 50 and Wall Street in general is picking the winners and losers of the new world. What is the new normal? And they're looking at down the road, 6-9 months down the road plus, and looking at who will be the winners. And the current winners are clearly in two segments of the market, is in the technology as well as the biotechnology, pharmaceuticals, and so on. So that is kind of the best answer I can give. Next question. You can open your microphone.
I have a question for you, Avi.
Yes, go ahead.
So you were mentioning that the impact of coronavirus on jobs and how many people are at risk of losing their job, 19% in Los Gatos, 50% in East San Jose, et cetera. Let's say it was 30%. A couple of years ago, the big news was that there was some survey that said that 40% of people in California in the Bay Area were unhappy and wished to leave, but couldn't for whatever reason. So if you combine those two things, not to be overly analytical, but you get like 12% of people will lose their jobs and they already wanted to leave anyway. So would you expect an exodus to occur in that scenario? Or?
That's an excellent question. Actually, the people who were, and I do track that information in my regular seminars, I talk about how many people are voicing their concern about moving from Silicon Valley. It's an absolute question. But also what's very important, when you look at those numbers, double click on those numbers. And I can show you statistics, which I don't have right now with me. It will take a few minutes to find it. I don't want to get a little bit on a tangent. But if you look at the distribution of who are the people who are coming to Silicon Valley versus who are moving to Silicon Valley, you clearly see a very clear trend. People who are coming to Silicon Valley are young, educated, and are making a lot of money. And many of them are actually also foreign born. So we have, when we look at that, there are two parameters. There is the immigration, which is typically foreign outside of the USA, and migration. Migration is within the United States. So you clearly see a very strong immigration, people from all over the world, basically United States sucking the brain power of the entire world, which is the US has two things going for itself. First of all, they can print money, and second, they can bring they print money that everyone in the world wants, and they are basically sucking the brain power of many places in the world. Was in the past, hopefully with a new administration, a new thinking, they're going to continue bringing those high-skilled, smart people from all over the area to Silicon Valley and continue to be the major power of innovation. Now, if we go back to your question, if you look at the distribution of the people who are living, then there are people who are older people, and typically less educated, and people who are not making a lot of income. So what we are basically seeing here is a major genderification of Silicon Valley. Only the educated, the young, the professionals can afford living here. Those who unfortunately have not participated in this economy have to leave. I hopefully answer your question.
Yes, thank you.
Other question, please.
I have a question for you, Avi.
Yes.
What does it mean to buyers that lenders are changing their requirements? Has this happened in the past, or was it usually after a crash, or is there any kind of event that can shed some light from the past?
Number one, it did happen in the past, obviously, and the vendors, basically, if you look at the financial crisis, and I would recommend anyone to look at this, read the book, The Big Short, and they basically describe there how loose and unresponsible lenders and the entire food chain of lending and real estate was back between 2000 and 2007. So, and as a result of that, lenders have changed dramatically their requirements. Okay, and these are the kind of limitations. There's no interest-only loans. There are no longer loans which are in what's called enticing loans, where they have negative amortization in the beginning and so on. And the requirements have changed dramatically from what's the maximum debt to ratio that you can go up to 43%, how much reserve do you need, that you need at least a certain percentage of down payment. So definitely it is changed. In addition to that, lenders have basically constantly monitoring the market, and they obviously don't want to be stuck with loans that are not performing and they have to do foreclosure and so on. Banks have learned big, very bad lessons of this last crisis. And the honest truth, in the last year or so, we have seen some of those bad practice by the lenders are coming back. I think that this crisis is basically going to reset that kind of tendency and going to be much more restrictive going forward. Last question.
Avi, did I hear you say that B of A has a minimum down payment requirement now of $3 million for a jumbo loan?
No,
Did I mishear you?
I said that the B of A has a 30% down payment for loans now, and these are yeah.